This is AI Finance Daily. We need to talk about software margins used to be 80%. AI companies get 40%. Here's what that means for your portfolio. Software margins, historically cherished for their robustness, are changing dramatically. Many observers hold the belief that companies operating in the software space can sustain margins as high as 80%. Yet, with the advent of AI, those margins are facing unprecedented pressure. Current estimates indicate that AI-driven software companies may only achieve margins around 40%. This shift prompts a critical question. Why is this happening? The answer lies in the fundamental nature of AI systems replacing traditional labor. Historically, software companies constructed their profitability around human labor, which, while costly, maintained healthier margins due to the value added. Now, as AI solutions step in, that labor is being replaced, but not at the same margin structure. Here's why this matters to you specifically. As investors, it reshuffles the landscape of valuation for software-as-a-service portfolios. AI integration has created a new normal, reducing the profitability cushion that many software firms relied upon. When analyzing these companies, one must consider how the reduced operating margins will affect earnings forecasts and stock valuations. The number everyone missed is that many analysts still cling to outdated models that forecast high margins ripe for the tech industry, a fundamentally flawed approach in the current environment. With the operational cost structure shifting toward the implementation of AI, the scalability that companies once experienced may not translate to similar financial outcomes. When evaluating companies in a portfolio context, traditional tech giants need a fresh lens. Take Microsoft, for instance, whose platforms now face competitive pressure from emerging AI players. Microsoft, renowned for its lucrative margins, is venturing into a territory where profit potential could be diluted, primarily due to AI integration. This is where the conventional wisdom breaks. Many investors are still banking on the traditional profitability model in an era where margins are in flux. The implications are critical. A portfolio heavily weighted in legacy software firms may soon become outdated as AI companies poise to redefine success metrics. One method of assessing this shift involves scrutinizing cash flows. Given that AI may necessitate a heavier investment in infrastructure, it's essential to evaluate how those flows translate into future profitability. Not all companies will adapt seamlessly. Many may struggle with debt servicing as operational costs necessitate significant capital expenditures. Consider the SaaS companies that have thrived on the back of clear-cut revenue models and high margins. As these models erode, investors must recalibrate their expectations. Examining venture capital backing in AI startups can help illuminate future winners and losers, a macro view offering foresight into potentially mispriced stocks. The critical takeaway is this. Investors need to adjust their mental frameworks. As AI develops, it may reshape entire industry landscapes. This could translate to a market where AI companies control the narrative, but with lower margin assessments. Do you hold any positions with inflated anticipations of margin durability? If so, reevaluation is paramount. Turning to the equity market sectors, the implications of these margin adjustments are profound. Industries like healthcare and finance are enhancing their services with AI, yet the margins could reflect a new, lower equilibrium. The structural forces here make substantive shifts inevitable. Thus, investors should gravitate towards companies more agile in their resource allocation, particularly those capable of pivoting rapidly in the AI domain. By favoring firms that can operate efficiently within this lower margin environment, there may exist an opportunity for future gains. In conclusion, as the reality of the AI margin collision surfaces, the opportunity for realignment is here. Investors must challenge outdated valuation norms while considering the onset of new profitability paradigms. Embracing a broader framework could lead to a more robust understanding of one's portfolio. Ultimately, transitioning into this new environment may not be without its challenges, but recognizing these patterns early could ensure that investors remain ahead of the curve. As these changes unfold, What sectors do you believe are at the highest risk or potential for resurgence? AI Finance Daily. Thanks for listening. If this added something to how you think about AI and money, follow the channel.